Hi, good morning. This is Hyperwave. I'm Leah Wald. We have Tyler Jenks. We are going to talk about mutual funds this morning. I wanted to go super live because if you can see, I know it's hard, but we have a sunrise in between those two buildings, actually here in Chicago. Boom. And then also, I'm going to try this one. You have Lake Michigan straight through. I am on North Michigan Avenue. So I want everybody to have a little bit of a beautiful morning. And yes, carnivore dinner with my family last night at Lowry's, if people have been to Lowry's, which is delicious. And I am talking way too much, but it is still 7 a.m. in the morning.
What
So
did you have for dinner?
Oh my God. Well, the prime rib, obviously, because it's Lowry's.
Yeah, great.
Oh, all right. Ty, enlighten us.
Well, thank you all very much. It's early here in the United States. I just had a wonderful discussion with a new consulting client in Kazakhstan. And so I was up early this morning. But we want to talk about mutual funds today. And we'll take about an hour. This is the kind of a vlog where you need paper and pencil or pen and paper, because I'm going to throw a lot of numbers out at you. And the reason I'm going to do that is because most people don't have a good mental picture of what the mutual fund market is really like or about, or how long it's been doing what it's been doing, and what a major role it plays in world finance. And to get a perspective of that, I'm going to give you a lot of statistics, but that won't last forever. We'll just take 5 or 10 minutes to go through the numbers part of it. And then we're going to do screen share, and I'm going to pull up the techniques that I developed to understand mutual funds, to know when to buy them, when to sell them. You absolutely can use technical analysis as well as fundamental analysis. You can time them. The qualities are incredible. The characteristics are unbelievable for mutual funds. And I'll give you a little background of how I got into it and why, and how I developed various systems that a lot of people use now, specifically for mutual funds. And then I'm going to pull up the decision-making process of how you evaluate a mutual fund. And we'll do that through a screen share. But for now, I just want you to understand that mutual funds are the financial instrument that has helped propel most of the financial growth in the United States and continues to do so right through today. They started back in the 1920s, and regulations weren't written about them until 1940. Now, all the regulations about stocks and bonds and brokerage firms and exchanges were written 7 years earlier in 1933 and 1934, the Securities Act of 1933 and 1934. They did not specifically talk about mutual funds. Mutual funds started being regulated in 1940 under what's called the 40 Act, which is for investment companies. And we won't go into any of those details, but they're very fascinating. And the regulations have basically been unchanged right up through today. Now, the regulations cover things called open-end mutual funds, closed-end mutual funds, unit investment trusts, and recently a new thing that just came along in 1993, ETFs. All of those are considered funds under the 1940 Act. And so the 1940 Act is where you go to understand how it's regulated. Unless you're in the business, you don't need to know any of that stuff. But I'm just giving you a little bit of a background. Now, we're going to fast forward from 1940 to 1971, and not to talk about Nixon closing the gold window, but talking about Tyler Jenks buying his first mutual fund. I had not yet gone to business school. I didn't know anything about finance. I had never taken an accounting course, and I was in the U.S. Coast Guard, and I was in Hawaii. And I was the executive officer, and the senior officer, the chief executive officer of the station we were at, was a very entrepreneurial captain in the Coast Guard, and he loved to do all kinds of fancy things with his money. And he and I got into the silver market back in 1971. That's how I learned all about the Hunt brothers and silver and gold. We got into a business where we were selling puka shell necklaces all over the country. And we did a lot of interesting things. But he also told me I should buy real estate in Hawaii because he was buying real estate. And he said that I should buy this thing called Taco Bell, which was a new franchise. Just fun stuff. So a great guy. We got to be very close friends. He also said, "What are you doing with your money?" And I said, "I don't have any money." And he said, "Well, you should start buying mutual funds a little bit each month. Just put, $10, $20, $50 in." And I said, "Well, okay, I'll try this." And so I bought a fund called the Chemical Fund, which was a very big mutual fund back in the early 1970s. And that was my first entree into learning about mutual funds, how they worked. I thought, wow, this is really cool. And then I went to business school at night when I was in the Coast Guard, got my master's degree in business. Then I went right into the financial world by going to work at Dean Witter and Company in Honolulu, Hawaii. Okay. From that point on, all I did is learn about stocks and bonds and options and annuities and selling product to clients, because that's what brokers do. And I was not interested in doing that. I wanted to learn how all this stuff worked. And so I began to start analyzing and learning technical analysis. Then I set up my own company, and we managed money for people. And then I moved to Boston, and I set up a company to do only one thing, and that was to be a research company about mutual funds, because somebody talked me into it, and I noticed that there was no research on Wall Street in 1985 about the fastest growing financial instrument in the world, mutual funds. You couldn't walk into Goldman Sachs, you couldn't walk into Merrill Lynch, you couldn't walk into Morgan Stanley and ask to see the analyst for mutual funds. They did not exist in 1985. There was no Morningstar to analyze mutual funds. So I set up a company to do that. It was called Cannon Block Carré. I sold it years later to actually begin managing money using mutual funds in 1991. So for 6 years, I ran this company to analyze how mutual funds actually worked and how you could predict what the good ones were and the bad ones. And that's what we're going to talk about today. So I spent 6 years doing nothing but doing that and meeting all of the people at the mutual fund companies that actually ran the money, mainly on the East Coast, because I didn't have enough money to travel around the entire country, and we were a small growing company. But then we began to get fairly notorious, because I started doing articles for Barron's and Wall Street Journal, and every quarter we did articles for U.S. News and World Report using our techniques, and they would do 6 or 7 or 8 page spreads about the best mutual funds using this new technique called OPI, Overall Performance Index. At the same time, Morningstar started in Chicago, and they quickly grew into a behemoth that then went public, and they sold it for $50 million, doing the same thing that my little firm had been doing for years before that. Okay, so that's the background. So what did we find, and what has happened since 1985 in the mutual fund world? We're going to start with the amount of money in mutual funds around the world. There is $50 trillion in mutual funds around the world. $49.3 trillion in open-end mutual funds. 22 trillion of that is in the United States. 17 trillion in Europe, 6 trillion in Asia Pacific, and the rest of the world 2.9 trillion, a total of $50 trillion. The total GDP of the United States is less than the amount of money in the United States in mutual funds. The largest economy in the world, the United States, produces through all of its goods and services on a yearly basis less money than is sitting in the United States in mutual funds. Number two, in the United States, of that $22 trillion in mutual funds, 18 of it is in open-end mutual funds. 3.4 trillion is in exchange-traded funds, which have only been around since 1995. So we've gone from 1993, we've gone from $0 to 3.4 trillion in ETFs in the United States. There's 275 billion in what are called closed-end funds, and you've heard me talk about that because it's an unusual type of a fund that is under the 1940 Act and is more similar to GBTC, the Bitcoin Investment Trust, than GBTC is to an ETF. It's not really an ETF, it's more like a closed-end fund, and we will do a separate show on closed-end funds at some point. There's $275 billion in it, but that pales, obviously, in terms of how much money is in open-end mutual funds. And then there's $85 billion in a thing called unit investment trusts. And I do have a number of clients that have money in them, and we don't need to talk about them today. Okay, so I just wanted to go through those basic numbers to let you understand the scope of this thing that we're talking about. People look down their noses at mutual funds, as if you don't know how to invest, buy a mutual fund. If you don't know how to pick stocks, buy a mutual fund, buy an index fund and just sit in it for the rest of your life, which is absolute nonsense. There's a reason there's that much money in it. And it's not by uninformed or ill-informed investors. It's by all the largest institutions in the world. When we were managing money for large institutions, we only put money in mutual funds. These are some of the biggest retirement accounts in the United States. And we would put all of their money into mutual funds because that's the best place to be instead of individual stocks or individual bonds. And I'm not going to try to sell you on that. I just want you to understand how important these things are and should be in your portfolios. Now, some more numbers to write down. In the United States, the number of households that own mutual funds is 57.3 million. That's households, that's not people. A household is made up of, on average, 4 people, but even if you say 3 people, you're talking about 45 to 50% of every house you go by in the United States, in their portfolio, there's a mutual fund. It's usually in a retirement account, but it's extensive. And those numbers aren't nearly as much as you go around the world, but it's impressive. We've got, Leah and I now have clients, consulting clients in about 9 countries in Europe, and each of the countries have their own mutual funds. Switzerland has their own mutual funds. Germany has their own mutual funds. The UK has their own mutual funds. 61% of households in the United States have retirement savings. You've already heard us talk about very little money are in those savings, but those that are almost all invested in mutual funds. There's $8.8 trillion in retirement accounts in the United States. They're invested in mutual funds exclusively. $8.8 trillion. Okay, so mutual funds are a big deal, and they're becoming a big deal around the world. We use mutual funds as well as ETFs as the best way for clients around the world to get access to markets around the world, including in the United States. Because in most countries, you can buy ETFs or US mutual funds through local brokers in other countries. So it gives the ability for clients around the world to be able to participate in the US markets. So let me just give you some quick overviews of what's going on around the world in terms of mutual funds. I've got a graphic in front of me that's a little bit difficult to describe, but I'll try to break it down for you. What it's showing is that those countries around the world that have the most developed stock markets tend to have the most developed fund industries, mutual fund industries, as you would assume. That was not true 15 years ago or 20 years ago or 30 years ago. Usually those with the most developed stock markets only had stock markets. But everybody's been looking to the United States and saying, what the heck is going on? We've got in the United States $22 trillion invested in mutual funds. Guess how much money there is in all of the stocks in the United States traded on stock exchanges? It's only about $10 trillion. Wait a second. How's that possible? You're telling me that there's twice as much money in mutual funds, and the only thing mutual funds do is buy stocks and bonds. There's more money in mutual funds than there is in all of the stocks in every corporation in the United States. But those mutual funds are only buying those stocks. So how can there be more money than there are in stocks? And there's a lot of answers to that, but just know that the mutual fund market is much bigger than the stock markets. Much bigger. Okay, what I'm going to give you now is I'm going to break down certain countries around the world in terms of the percentage of the total assets in open-end mutual funds in their country compared to their GDP. And the number one is in Australia. Australia has got more money in mutual funds than the GDP of their country, on the order of 50% more. I've already given the United States. The US has about the same amount of money in mutual funds as GDP. So it's right about 100%. Netherlands is even greater than the United States. The Netherlands has more money in mutual funds than the GDP of their country. Switzerland, Canada, the United Kingdom, France, and Germany all come in at around 50%. Japan, the Republic of Korea, China, Russia, Poland come in at less than 10%, and every other country around the world is down at 1% or lower. So there's only about 15 countries that get the joke and understand what a powerful tool mutual funds are in terms of letting their populations participate in the economic growth, the GDP, as well as their own stock markets in a very efficient manner. Okay, enough of my sales pitch about why everybody has got to change their viewpoint on mutual funds. Now, what I want to do is I'm going to go to screen share, which means my microphone will probably shut off. And I want to pull up some, just one exhibit with a number of pages in it, which is a presentation that I put together a long time ago for clients to understand what it is that I actually do with mutual funds. And it starts with what I call market segment analysis. And I've got it broken down just into two groups, equities and fixed income. What I want to understand, and now we're not talking about mutual funds or ETFs or stocks or anything else, but this is something that it's important for me to understand, to be able to understand how markets are moving. In the stock market or the equity market on the left side of the screen, I list four things: capitalization, management style, risk, and sectors and industries. What I mean by those four things, starting with capitalization, is the size of companies. Companies in the US, publicly traded companies, privately traded companies, can be broken down in terms of their size. And if you just follow with me for a second, a micro cap company is considered to be $200 million or less. And many of them are publicly traded, and they trade on over-the-counter stock markets or in the pink sheets. But they are not private, they're public. There's also a lot of small privately held companies, but we're talking just size now. Those are called micro cap stocks. Cap means capitalization. Then you've got small cap stocks that run basically from about $500 million. Micro cap is 200 million to 500 million. Small cap runs from 500 million, which is the same, of course, as a $500 million, up to about $2 billion. And there's a huge number of those. There's 2,000 of them in the Russell 2000 index that are publicly traded, and they basically run between $500 million and $2 billion. Those are called small cap stocks. There's a third category that is called mid cap stocks, which basically run between $2 billion and about $15 billion. These are not set numbers. It's just generally used in general terms within the industry. Those are called mid-cap stocks. And then there's what's called large cap stocks that run from about $15 billion up to $100 billion. Some people cut it off at about $50 billion. And then you've got the super large cap stocks that run either from 50 billion up to $1 trillion or 100 billion up to $1 trillion. Now, why in the world do I think that's an important observation? That you can put every company in the world into one of those, let's call it 5 buckets: micro cap, small cap, mid cap, large cap, and super large cap. The answer to that question is, by knowing the size of a company and what bucket it is in, you can draw conclusions about what all of the companies in that bucket are doing relative to all of the companies in other buckets are doing, because it will differentiate the performance you will get by bucket. Small cap stocks as a bucket move differently than large cap stocks as a bucket. You can do your own research on that, but I'm telling you that is a truism. Okay, that's capitalization. Management style. Management style doesn't have to do with autocratic or bureaucratic or committee. It has to do with growth versus value. There are various ways of looking at a portfolio of stocks and determining which ones are consistent with the way a client or a money manager or an investment firm or a mutual fund company is going to approach the decision-making process of how they're going to weed out some companies from other companies. We've already talked about one that's called capitalization. But this time, what we're going to do is we're going to break management style down into two basic pieces: growth and value. Value is what Warren Buffett stands for, and what value investors look for. And growth is what investors that are looking for revenue and cash flow and price to book that is indicating this company is growing very, very quickly. In between those two extremes of deep value and high growth are 10 or 20 subcategories, right in the middle of which is a thing called growth at reasonable price, which is called GARP, G-A-R-P. So if you've got value investors like Warren Buffett on one side, and you've got growth investors on the other side, in the middle, you've got growth investors that will only buy a stock that is trading at a reasonable price, which is using value type of investing formulas to weed out certain stocks that don't fall within certain parameters. So take that entire spectrum and let's call that management style. Why do you do that? Because growth stocks as a bucket act differently in the marketplace than value stocks as a bucket, and as all of the subcategories in between as buckets. So once you've learned to put a stock or a mutual fund into a bucket, by knowing number one, capitalization, and number two, management style, you can begin to differentiate between not only stocks, but groups of stocks called portfolios, or securities by the names of mutual funds or ETFs. You begin to be able to differentiate between them. The third on my list is risk. And risk means, how does a stock work relative to other stocks or indexes? Does it have a higher volatility or a lower volatility? For now, let's just call that beta, which is the amount of volatility and return that a security or an index or a mutual fund or an ETF has relative to something else, either a money market fund or a riskless investment or an index. And you can arrange every stock and every security and every mutual fund, and by the way, every cryptocurrency by these kind of designations such as risk. There's all kinds of ways to measure risk, and there's all kinds of ways of measuring reward. One of them is just beta, which is the relative movement of a price relative to something else. Why do you do that? Because something with a beta risk of 50 against the S&P 500 or 0.5 means that we'll go up and down in price at 1/2 of what the underlying index that you're comparing it to moves at. If the S&P moves at 1.0 and you're looking at a stock or a mutual fund or an ETF that moves at 0.5 to that S&P 500, that means if the S&P goes up 10%, you should assume that this stock, mutual fund, or ETF is only going to move up at 5%. You can also assume that the S&P drops 10%, that something with a 0.5 beta is only going to drop 5%. Okay, why do you do that? Because in an up market, if you have securities or mutual funds or ETFs that have betas of 1.5, you are going to return 50% more than the S&P 500 on average. But in a down market, you're going to lose 50% more than the S&P on average. Therefore, those two buckets of 50% and 150%, all of the members you have put into those buckets, you can predict what they're going to do relative to all your other investments by looking at this one measure called risk. But you have to have already put them in the bucket. You must have made that determination, as you did with capitalization, as you did with management style. And finally, we're going to go to the last one, sectors and industries. All sectors move differently. All industries move differently. All of the companies in those sectors and those industries move differently than in other sectors or other industries. And I've shown you that before. I will quickly show you that again. But if you do those four things and you understand those four things on any given stock, mutual fund, or ETF, you can then begin applying technical and fundamental analysis to those buckets, and you are now in control of your investment horizon and your investment future. Now, I can go through the same things for fixed income, but I'm not going to. We will do that on another day. You can do the same thing by looking at credit quality, maturity and duration, yield, and what sectors they are invested in, and do the exact same thing that we just talked about with equities. Okay, I'm now going to drop down to this slide and tell you that what we just did in analyzing buckets and characteristics of securities, you can apply directly to mutual funds. When I wrote this, there were only 15,000 mutual funds with $10 trillion in it. This was 10 years ago that I put this particular presentation together. We are now up to 22 trillion in the last 10 years, and we're up to 27,000 mutual funds from that 15,000 number. But what we are now going to do is parallel what we just did with that last slide. We are going to break mutual funds down, fund by fund, into these groups: value and growth, large cap, mid cap, small cap, micro cap, super large cap, materials, financials, healthcare, industrials, utilities, energy, consumer staples, consumer discretionary. And the amount of risk relative to each of those things that the portfolio you are looking at has. Now, if each person on this call were simply to go to the chat and write down the name of one stock at random, whatever it was, one you liked, one you hated, one that you're following, one that you read about in the newspaper, you just put the name down. And let's say there's 1,000 people watching this. We will have something like probably 250 names because there will be a lot of duplicates. We got those names randomly. We take those 250 names and we put them into a portfolio, and we equal weight that portfolio 250. What's that?
No, your mic came back. You're good.
Okay, very good. So we now have a portfolio of 250 random stocks. We can now analyze that portfolio using this technique. We can determine if it's heavily weighted to value, heavily weighted to growth, heavily weighted to large cap, mid cap, or small cap. We can tell if it's blended between large cap and mid cap, or mid cap and small cap. We can determine how many of them are in energy and industrials and financials and consumer staples. We can actually analyze that portfolio relative to the S&P 500 in terms of risk. And now what you have done is you have done what I do when I analyze a mutual fund in terms of what it is going to be able to do in the future. And the reason we can do that is your portfolio, the one in the center, can be an ETF. It can be your real portfolio if you've bought 10 or 15 or 20 or 5 stocks and you've got it sitting in a retirement account. If you do these 4 things, capitalization, management style, risk level, and sector, you can now forget about your stock or your mutual fund or your portfolio, and you can draw conclusions based on studying what small cap stocks are doing relative to the S&P, or what growth is doing relative to value, or what high beta stocks are doing relative to low beta stocks, in terms of the trends of those right up through today. And now, because you understand what your portfolio looks like, you've got a good view of what the future holds for your portfolio. In my case, I do that for each stock, each mutual fund, in order to recommend to clients where they should be relative to those mutual funds. And that's how we build all of those portfolios. Now, I told you I'd give you a quick look at this, which is, in this case, a breaking down of various types of asset classes. We're going to look at the Lehman Brothers, which is now just called the Aggregate Bond Index, which for this particular year we were looking at, which I think was back in 2009. Yep, in 2009, the Lehman Brothers Aggregate Index looked like this. It was up at the top of the ranking of all the asset classes we were looking at. And so if you go back 20 years, you see where bonds have ranked relative to other asset classes. On 3 occasions over 20 years, it was at the top of the list. And at one occasion, it was at the bottom of that list. But on 1, 2, 3, 4, 5, 6 occasions over 20 years, it was second from the bottom. And on 5 occasions, it was third from the bottom. That's all this stuff down here. That's for one asset that's called bonds, in this case, an index called the Lehman Bond Index. Sometimes they're at the top. Sometimes they're at the bottom. Sometimes they're in the middle. Now I've filled out the chart with a bunch of other asset classes, including the white boxes, which are MSCI, Europe, Asia, and the Far East. These are international stocks during this 20-year period. On 6 occasions that they were at the top of the list. On 2 occasions, 3 occasions, 4 occasions, they were at the bottom of the list. These are relative rankings of asset classes, and I've got small cap, I've got mid cap, I've got the S&P 500, I've got the NASDAQ, I've got large cap growth in the S&P 500, I've got large cap value in the S&P 500, only to illustrate that what I said before about the 4 main characteristics of securities is always true. And that is, if you buy and hold any of these colored boxes, you will take a ride up to the top of the charts for a matter of months or years. And by holding them, you will ride them all the way to the bottom of the chart, where what you could have done is you could have been watching the trends of these boxes and moved from those at the bottom into those at the top. And those at the top, as they begin to come down, get out of them and move to things that are moving up the chart. You can do this on an annual basis like I show here. You can do it on a quarterly basis. You can do it on a monthly basis. But you've got to understand the principle of what you're doing. Every mutual fund is made up of these boxes in various combinations. But you know that before you buy the mutual fund. Therefore, you know that when it comes time to make switches out of different types of mutual funds, out of bonds into stocks, out of stocks into large cap stocks, out of large cap stocks into NASDAQ stocks, out of NASDAQ stocks into small cap growth or small cap value. That's how you should approach a mutual fund. Well, Tyler, thanks. That's very interesting, but there's not enough time in the day for even one person to do that on a full-time basis. Okay, I agree with that. What I'm telling you is that the right way of looking at your investments, no matter how small or concentrated they are, if there are in individual stocks or individual mutual funds or ETFs, you can certainly look at them from a new perspective by using these techniques. And you can find a lot of this information right on the web, right on either the mutual fund family website or the Morningstar website or the Fidelity website or Schwab or E-Trade. You just have to go into it understanding what you're looking for, understanding what really drives price performance with individual stocks and companies, as well as in grouping of stocks, which we call funds or ETFs or closed-end funds, or your own personal portfolio, which you can look at as a mutual fund. It's one that you built yourself and you're managing. But that doesn't mean you can't use these techniques to understand what it is you've got and how it works. Now, I've pulled up the 10 sectors of the economy: the financials, infotech, consumer discretionary, healthcare, industrials, materials, and shown you the same kind of a breakdown that I showed with asset classes. You see that things are at the top for a period of time, and then they drop to the bottom for a period of time. and then they go back up to the middle for a period of time. And therefore, if your stock falls into one of these buckets and has been doing well, such as Infotech in 1993, 1994, 1996, 1998, 1999, before we got the dot-com bubble burst, and then we had Infotech at the bottom, down 40%, down 37%. In 2 years, 75%. And in the intervening year, it was down 26%. At the same time, we had utilities up 5%, consumer discretionary up 20%, and consumer staples only down 6%, before Infotech came back in 2003 and was up 48%. Now, some people will say, okay, so I went for 3 years holding my Infotech stocks, and yes, I lost 80% of the value, but look what happened. It went right back up to the top in 2003, and therefore I should have just stuck with it. To me, that's the ultimate of ignorance, because I've shown you techniques that you can use where you don't have to jump in and out of things, but you can take a long-term perspective at looking at trends. And when you see those trends beginning to shift, that's the time to begin thinking about shifting, because of all this evidence that I'm presenting you now, that this is the real way that the markets work, that economies work, and that people that are successful in the financial world recognize and take advantage of. All right. I didn't mean to overwhelm everyone. I don't think I did. I believe we kept it to the main points. We have not gone into how you actually make these determinations with a mutual fund. And we can do that in another vlog, or we would be interested in your thoughts about this type of analysis in a webinar setting, where we actually take 2 or 3 or 4 funds and go through the analytics that you can go through using this kind of thinking. What I'm trying to teach here is perspective, the conceptualization of what you're doing. You're not simply taking money out of a checking account and throwing it into Bitcoin, or taking it out of a checking account or a savings account where it took you a long time to get that money together and save it, and throwing it into Google or Tesla or a mutual fund. You've got to understand that you are taking an asset, cash, that is very safe, and you're putting it into something that is less safe. And you've got to understand, when you go through that process, how does that thing I'm putting it in, what is it going to do in the future? What's the probabilities of things happening in terms of it going up or down? And I've just given you 4 clues that you may or may not have thought about in terms of capitalization, in terms of management style, in terms of risk, in terms of sectors and industries, to think about everything you do. And that can be applied to the fixed income space, bonds. It can be applied to the crypto space, in terms of looking at trends, understanding what certain things in the crypto space do relative to other things, which is risk. What is the risk of an altcoin relative to Bitcoin in up and down trends? If you don't understand those simple principles, you shouldn't be throwing your savings and your checking into these things. And it won't take you long to understand it, but you have to conceptualize how this works. So enough of all of that stuff. I'm going to turn it back to Leah and see if we've got any questions.
I think we're good on this morning. We're actually right at 4 minutes to
Great.
end. Plus, I am rushing to the airport. That was awesome, Tyler. Anyone
Great.
that does have questions, please write into us.
Yeah, you can always get us by either writing in on chat or just go to our website at lucidfunds.com, because on that website, you can, filling out a submission, just say, I've got a question about what you said in your last, and we will get to every one of those. It's a great way to communicate with us. And Leah's laughing because she's the one that has to answer all those questions. Okay, thank you all very much. And Leah, get to the airport. Thanks, everybody, for listening.
Thanks, everybody. Have a wonderful day. And then we'll definitely talk Bitcoin next. But yeah, thanks, Ty. And yes, I will be answering all of your questions and sending it to Tyler. So have a great day.